Like if you're living in the Western system, you should have banking in the non-Western system. If you're living in the non-Western system, you should have banking in the Western system, and vice versa. Like that's just logical, right? And I'm not sitting here saying there's good guys and bad guys. I think all of these people are complete psychopaths. But what you got to understand is that the psychopaths are going to battle one another, and they're going to utilize you and I as cannon fodder if they can. And it's our job to make sure that they don't, and so that we can actually escape that on a physical basis as well as with our capital.
Hey guys, welcome back to Capital Cosm. Today we've got Chris Macintosh from Capitalist Exploits back on the show. Chris, thanks for coming on again.
You're welcome. It's good to be back.
Yeah, and if you guys are enjoying this content, be sure to give us a like and subscribe to the channel if you haven't. 85% of you guys who watch the content are still unsubscribed. If you don't mind just hitting that subscribe button, it doesn't cost you a thing, and it takes less than a second. It would go a long way on helping me on my end. So I'd really appreciate it if you hit that subscribe button. Okay, Chris, let's go ahead and dive right in. What is your kind of overview of the economy at the moment? Broad strokes wise, like say 50,000 foot view wise. What do you see happening out there in the economy, the markets, et cetera? It's been about 2 months since we've last spoke.
Sure. Yeah, gosh, there's so much to talk about. Broadly, what we discussed last time we were on, I suspect, hasn't changed that much. From a macro viewpoint, we're still in the phase where you're getting, I think we're in a blow off top with respect to growth equities. I think we're in a blow off top, or have seen the blow off, or the top at least, of the bond market, of the sovereign debt markets. Certainly if you go back and you look at the sort of long-term charts, that's indicative. So what that means on a go-forward basis is higher interest rates, and that's going to severely affect indebted markets, indebted governments in particular, which then there's only a couple of ways that is normally addressed, even where the debts are not as magnificent as they are today. And so the ways that they address those is default is one of them. The United States isn't going to default necessarily, but because they can print their own currency, but there will be a synthetic default of some nature. Ultimately, what it means is that there are a lot of the liabilities that exist within the system, especially domestic liabilities, i.e. pension funds, healthcare, education, eroding infrastructure, whatever is tied to those sort of domestic liabilities. Those are going to be repudiated on because they're unpayable. On an international basis, that gets a little bit more tricky, because if you default on an international basis, it can bring war. However, war can also simultaneously be a good justification for default on a domestic basis. So you kind of, if you think about a debt market from a sovereign side, and you've got a portion that's your domestic liabilities, and then you've got your international liabilities. If you default on the international liabilities, or you create problems of any nature within that international space, you can justify to your local populace why they basically aren't going to get their milk and cookies. And so that's also, again, been one of the historical precedents that exists. Something of that nature is coming. It doesn't really matter how that transpires. The net result is similar. And the net result is that you have a stagflationary environment whereby your asset allocation is vastly different to that which your average mutual fund, pension fund is invested into. And so to be specific with respect to what the mutual funds and typical investment portfolios look like, it's some variation of a 60-40 equity bond split, or what is otherwise known as a risk parity trade. That 60-40 bond split is, with respect to the equity component, is largely S&P 500. We've talked at length about the issues that we've got with respect to the S&P 500, which is that it is of the top 10 stocks in the S&P 500, they account for over 30% of market cap now, which is higher than we had in the TMT bubble. It's problematic. And and the valuations accordingly are out of whack. So it's basically your Mag 7 plus a few others. When that particular train slows or reverses, I think we have a serious issue in that in when people talk about equity markets, they're basically talking about the S&P 500 or the NASDAQ or some variation, something like that. And so those markets are problematic from that front. To be clear, when people say, to me, are you worried about the equity markets? I go, yep, I am. And they go, what are you invested in? And I say, well, I'm invested in the equity markets. But to be clear, what we're invested in is absolutely not in those overvalued sectors. We're invested largely in the stuff that we talked about last time, I suspect, which is historically the lowest. Well, it's energy and commodity markets, and those as a representation of the S&P 500 are the lowest they've been in pretty much in history. So I think there's a case to be made, and I'll make it, that when you get redemptions from these large passive capital flows, and that's what they are, they won't be selling what we own because they don't own it. To put this into some context, if you are a BlackRock, Vanguard, or even smaller funds, you're typically running large capital, billions of dollars. And as a consequence, you don't have the ability to go in to buy into middle small cap companies, which basically what is left within the commodity space. They've been so decimated and so beaten up that their market caps are now a fraction of what they used to be back in the previous highs. And so there's an inability for passive capital to actually enter those markets because of the size. And the other thing that you need to understand is those passive capital flows they're not decision making. They're not allocated on a valuation basis. They're allocated on a liquidity and market cap basis. In other words, they don't care. The capital comes in and it has to be allocated, and the algos say, okay, where can we enter X number of dollars? And it's large pools of capital, right? And so it needs liquidity and it needs market cap. The two are correlated. Typically, the larger your market cap, the larger or greater your liquidity. There are variances. So, before anybody starts sending me, some anomalies, it's a broad statement. And so what it means is all of that capital tends to go into the same equities. And then as those equities rise, your market cap rises and your liquidity rises, which then in a feedback mechanism says, hey, we can allocate more to this. What it also does is it dampens volatility. And dampening volatility causes, in terms of the way that these models work, they assess volatility as risk, or at least as a risk component. So if your volatility decreases, they go, hey, you know what? We got less risk. Therefore, we can allocate more. And the more you allocate on a continuous basis, the lower it dampens volatility. So you can see how this works. The issue that I've got with this, and I don't know when this ends, but firstly, the valuations are completely out of whack. That component, as I mentioned, within the S&P 500 is now, I think it's about 33% of the S&P, which is about 84.5 percentile. It's completely out of whack. It's vastly higher than it was in the TMT bubble and previous other bubbles. What the issue that I have is those passive capital flows come in from the underlying market. In other words, it's an allocation into 401k plans, as an example, right? You're working your day job, you're earning whatever you earn, and a certain portion of that goes into your plan, and then it therefore gets allocated out. That's your basic economy. That basic economy, we're watching that deteriorating, right? We're watching people getting squeezed on inflationary pressures. We're watching wage stagnation relative to purchasing power, because some people are going, oh, well, wages are going up. True, but they're not going up at the same rate as your basket of goods. And when I'm talking about the basket of goods, I'm not talking about the bullshit CPI that these twats put out. You can go and look at, what's it called now? I put it out in the last newsletter, the Chapwood Index. So the Chapwood Index basically takes 150 consumer items that are typically utilized by most people, and it says, what is the inflation rate on these things? And it goes in, it does it state by state. And what you're going to find is that your actual inflation is running anywhere from about 9 to 13, 14%. Okay. That's a decimation of capital. So if you're getting, let's say you're on the low end, 9%, right? And you're running a 9% annual reduction in purchasing power, and you get a 5% wage increase, you're still getting a 4% loss of purchasing power. Now you're going to have to go and allocate towards your 401k place. Something like it's got to come from somewhere. And so I think we are getting very close. And maybe we're there. Again, I'm not trying to time this, but there's going to come a time when those passive capital inflows slow or reverse. And when that happens, this entire mechanism goes into reverse, and you start getting redemptions, and your volatility starts increasing, your market cap starts falling, and the algos go, hey, you know what? If we've got a X% fall in bar equity on a risk basis, we have to now get out of it, and we have to reallocate. And so then it goes back and it says, well, where do we allocate this capital to? So both you get a bit of a redemption and you get a reallocation of capital. We talk about it in the next issue that we're putting out, which is what we've watched over the last few weeks is a bit of a rotation from your Mag 7, if you will, your top 10 odd companies, into your smaller cap companies. Now, does that mean this is the end of the gravy train? I don't know, but it's interesting to watch. So yeah, there's a lot going on, but broadly, I don't think there's a whole lot that's changed. That's kind of almost like on a domestic US centric basis, what I'm talking about there. On an international basis, we're still watching what we've been talking about for freaking years now, which is a transfer of ultimate wealth from the West to the East. As we financialized all these assets, our market caps in the Western world are extreme. If you look at market cap weighted annually, the US is way ahead. At the same time, if you look at GDP or even purchasing power parity, this is completely out of whack. China, and I'm no, champion necessarily for the CCP, but China has a larger GDP now, and its percentage of market cap with respect to equities is something like I think it's 2.6% or something. It's fractional. The US is like up at around 26%. So like you've got this massive disconnect. And now let's go back and think about what's been happening for the last, 40 odd years. Businesses, as a consequence of higher labor costs in Western markets, increased regulation, have arbitraged labor, right? And they've said, okay, we're going to move, like Nike, we'll move our factories to Vietnam, or we'll move them to Bangladesh, or we'll move them to China. Same as Apple, all these anyone that's producing stuff. Their business model has already moved production out of the West. What's left in the West is intellectual capital. Tell me, if you've got a business, what's the hardest part of your business to move? It's the production facilities. It's the logistics. That's the hardest part to move. If you worked for me, or if I worked for you, and you wanted to move me, it's me and my laptop, and I'm on a plane. It's not hard, right? So that component is actually the easiest component to move. And now what we're watching in the West is an increased pressure on that component of the market, higher taxes, higher living costs. And the argument that you say, well, I'm living in a first world environment and it's safe and it's nice, and there's a price that I pay for nice roads. There's a price that I pay for good education. Well, what's it look like now? If you're living in London, you're in stab capital. Anywhere in the West, you're sending your kids to school and they're being taught just garbage. Um, and that girls are boys and boys are girls and all this ridiculous nonsense. Your roads are falling apart, your airports are falling apart, and they're now looking at implementing higher taxes. So the justification to stay is much lower. And so as a consequence, you're seeing human capital beginning to move. That the second order effects of that are typically, and this is a historical precedent, that governments will look to they'll look to address that, and they'll address it via capital controls. And capital controls, by the way, can come in all sorts of shapes and forms. That can come via, for example, an inheritance tax. It can come via an exit tax, right? If you are to give up your citizenship, you might have to immediately pay tax on all your capital gains. If you are to simply leave the country, whatever country you might be in, permanently, there might be an exit tax. If you are just to move capital outside of that jurisdiction to a foreign jurisdiction, there might be a tax. That sort of stuff is just capital controls by another name. I think all of that is coming, and it's probably just around the corner.
Has that happened historically? Is there historical precedence to all that?
Absolutely. It's funny because, I grew up in Africa, and I've got friends or had friends, I've lost touch with a lot of them, who lived in Zimbabwe and went through a lot of the crisis and things that went down there. Um, and there's I've researched in many other instances. What's interesting is that the very mechanisms that they chose there are the same sort of mechanisms we're watching now being rolled out in the West. But what the difference is that in those jurisdictions, typically people go, yeah, we know we live in a third world shitty dictatorship or
Right.
whatever it is. We're kind of accepting of it, or we're not surprised when that happens. For most people in the West, they can't imagine that it would ever happen. And so they're really unprepared.
Yeah. Yeah. Especially like if you live here in America, you think you're living here at the seat of the world empire. But if you look around, there's obviously been a huge degradation of, like you mentioned it, infrastructure, education, a host of other things as well. So as capital continues to move from west to east, as well as human capital, um, how how long does this world reserve currency that we have in the form of the dollar kind of maintain its presence? The British sterling took about 20 to 30 years to completely
Mm.
unwind its world reserve status. Now you have the BRICS group there. They've been working together to create a settlement currency, likely backed by either gold or some sort of basket of commodities. How long in the tooth are we in this de-dollarization process? When it comes to the brick settlement currency, all that stuff. Are we still kind of in early innings? Do we still have a couple of decades to go, much like the British sterling, or could this be like something that happens slowly and then all at once?
I I can't answer that question because I don't know. But what is evident is that there is a very strong move to finding alternatives. As the hegemon increases pressure, whether it be political, militarily, economically, on other nations, it accelerates that process. Um, a war, a hot war, a kinetic war can really accelerate it, whereby the um, the other participants in the market say, you know what, it's painful, but we have to. we have to move and we'll have to make some alternatives. And so economically, that can be basically a depression, a very, very tough period of time. But the justification is that you can't fund your enemy. So why would you? Outside of that, I've been making the case for a number of years now that despite all the calls for a dollar collapse, it's not really possible. It's not really possible because it still remains the reserve currency of the world, and it is the currency that is the settlement currency to most international trade. Roughly 90% of all international trade, the other side of that trade is in dollars. The other component is that we live in a credit-based system, and the US dollar remains that credit component. And so if you are to get rid of the dollar, you basically have to pay back the debt. So it creates a synthetic bid for the dollar. Imagine, for example, you and I are trading, and I owe you money or you owe me money, whatever, it doesn't really matter which way, and it's dollars. If I want to get out of the dollars, right, and I owe you some money and it's in dollars, and I'm like, I don't want to use a dollar anymore, I have to go and source dollars to pay you back, right, to then get rid of the dollars. And so ironically, the move to getting out of the dollar is a dollar bid. So there's that dynamic in play. Now, as we've just been watching the very interesting season finale of the U.S. empire transpiring, we have Trump probably coming into power in November, barring God knows what between now and November, and anything could happen. It's very difficult to envisage anyone else winning. If that's true, and you go and you look at his running mate, Vance, and you look at the policies that he's been espousing pre his selection and the policies that Trump espoused when he was in power, they're dollar negative. The idea for them is that we go out and we make America great again. So it's basically bringing back the Rust Belt. It's bringing back production to the United States. One of the big gripes that they've had is that China, because they don't have an open capital account, are manipulating their currency, which damages US businesses and gives them an unfair advantage. And so what you're likely to see if we see a Trump-led administration for next year is we're likely to see a weaker dollar, more sanctions on other countries, China in particular, tax incentives, tax breaks in the United States, specifically for production. I think probably we'll go back to drill, baby, drill, opening up oil fields, things of that nature. But ultimately, a weak dollar policy. There's an issue with that, of course, which is that the US now is running massive deficits. Financing, that's going to be an issue. The interest component on the debt now is higher than its total military spending. I mean, this shit's basically out of control. So it's going to be highly inflationary. But that's the indication that we see in terms of the podium donuts that happen to be talking about this stuff at the moment, who, if they do get into power next year, then that's likely the economic policies and that's the likely outcomes within the financial markets, higher inflation, et cetera, et cetera. So and then you could take it a step further and you say, okay, if they're going to weaken the dollar, what they're going to weaken it against, and how's that going to work? Of course, the Europeans need a much weaker currency, and so they're in a worse situation. The Japanese, as we've been watching the currency going into a slide, don't necessarily want a weaker currency. However, they have a huge bond issue. And so they're stuck between trying to fix the bond market and let the currency go. And they can't do both. Letting the currency go, well, the only thing they can do, because they are net holders of US treasuries and the largest out there in terms of an external basis, is sell the US treasuries to shore up the yen. which is probably why the tiny little midget went over there, what, 4 months ago to go and have a word with them, which was, we can see your currency's fucked, but for God's sakes, don't sell, and we'll put some other pressures on you because we can't have you selling US Treasuries. I'm pretty sure that's what you went over there to have a yarn about. So, again, now you come back, you go, if you're going to weaken the dollar, what you're going to weaken against? I think it just ends up being raised to the bottom because all these other markets and major currencies, euro, yen, dollar, sterling, they're all in the same boat. They're all going to have to weaken. So we're in, I think, in that environment, then it's everyone weakens. Very good for physical assets. Um, At the same time, we don't even need that because we're in a geopolitical conflict environment. The new administration is going to go, okay, fine, we're not going to go to war with Russia anymore. We'll put that on the boil. I think they're kind of just settled for what they're gonna. They'll be happy. I say the deep state will be happy. Why? Because they would have liked to have more of Ukraine, but they'll take what's left. BlackRock gets it all. We've seen BlackRock and JP Morgan now coming in to help them. So if you're a Ukrainian, you'll own nothing and be happy, which is true. That's after you've had half of your country slaughtered at the meat grinder for the globalists. So BlackRock will walk away with much of the country there, and then they'll go after the next enemy, which is Iran and China, and target that. But again, more war, more inflation, yeah. So from 40,000 foot view, we haven't made any particular changes to our asset allocations or our portfolio, other than, and you're probably familiar with this because I know you're a subscriber, is a position in some Ukrainian agriculture. So that's very cheap. I think by year end, we're going to have some peace deal of some nature, and we'll start seeing a bid. And these things can really, really run because you're buying into a war zone. I mean, they're like dirt cheap. So other than that, we haven't got any major changes that we see need to be made.
Yeah, yeah. I mean, I'm glad you mentioned that I was a subscriber. I've been a subscriber now for 4 years, guys. To Capitalist Exploits, Chris's newsletter here, my top of the line, my favorite newsletter out there. I can't recommend it enough. In fact, we do have a special. If you sign up through the link down below, you get a 40% discount on the newsletter. Be sure to check that out. You mentioned Ukrainian agriculture stocks. Looking ahead to likelihood in the war. You also, I remember, you also recommended Argentine stocks even before Milei came into power. That was a great trade that's played out. So massive value that you guys have provided for your subscribers there that I can't recommend enough that people check out. Link is down below. Okay, Chris. So we've been seeing wars pop up, geopolitical chaos all over the place, but then you see the oil price not do anything. Oil sitting at set. In fact, it actually sold off today, despite the bombing in Yemen by Israel, despite the assassination attempt on Trump, despite all this craziness going on. What is happening with oil? What is there in fact a war premium, a war risk premium priced into the oil price? So would that kind of imply that oil would be significantly lower had it not been for all the geopolitical chaos?
It's a great question. I'll put out a hypothesis, which is as a consequence of talking to a lot of fund managers and people in the industry. And what I see is this, especially Western US, large US fund managers pay very, very little attention to geopolitics. They're quite focused on the US politics in general and the US market in particular. Their huge concern is in a weaker economy, which will drive lower consumption. And they're allocating accordingly. So And that's by and large the vast pools of capital that exist on the planet, in terms of equity markets for sure. When I have conversations with them, and I had this conversation, what are we now? July, I guess it was June, beginning of June, um, over in Orlando, and I was talking with another asset manager there, a very, very intelligent guy, and we agreed on almost everything, excepting that his opinion was, again, this weak economic domestic environment, which led him to believe that the best asset allocation for him, or at least a big portion of his portfolio, should be in bonds, US bonds, and or treasuries. And the reasoning being, you have a weaker economy, those Mag 7, etc., come off the boil, and you go into cash. He didn't see commodities particularly as that attractive because, again, weak demand, layoffs, lower profitability for companies, closing of companies, basically a depressionary or recessionary environment, which ordinarily would be bullish for treasuries. And when I said to him, when I asked him, I was like, well, what about geopolitical conflict? That's historically, there's never ever been, at least from a war, like war periods, we've never ever seen a deflationary environment. It's always been inflationary. And he's like, well, it doesn't really affect us. And I was just shocked by it. But that opinion is broad, it's widespread. And I think it makes sense because if you look back for, well, pretty much since World War II, the United States has never been in any war that's affected it domestically. It's always been wars over there. It's been Iraq, it's been even Vietnam, it's been Syria, Libya, Sudan, and now Yemen. It's like, oh, it's over there. It doesn't affect us, right? So it doesn't have an impact. And I think that's a dangerous assumption in this environment. So, um, so that's my view on it as to why we're not seeing a significant bid under oil. There's a recession. I would say a recession premium on the other side to oil, which is where the asset managers are saying, well, no, we're going to have a recessionary environment and we don't want to bid oil. And my counter to that is a couple of things. And I know Louis Vincent Garva has talked about this quite a lot for anyone who wants to go and get deeper details on it. He makes a strong case, and I agree wholeheartedly with him that while Western asset managers and Western media in particular are talking about this deglobalization, that's largely a Western issue. While there's deglobalization from the Western side of things, you've got an entire market that's run sort of from Istanbul through to Indonesia of about 4 billion people. And almost every week that goes by, you're seeing more trade deals being done. You're seeing a relaxing of restrictions with respect to trade. You're seeing more and more globalization, literally, across that sphere of the world. And so you're very much, I'm watching a bifurcated world where on the one side, we're seeing a whole lot of things transpiring, which are very counter-cyclical to that which we're watching in the West. Very focused on the West, you're not seeing that. You're not even looking at it. You're saying, oh, we're going to have a recession. We're the biggest boy on the block. Nobody else matters. Buy treasuries. I get it. I understand. At the same time, you've got developing and emerging markets that are continuing growing. And there's an exponential factor which takes place when you have trade deals and you have inter-country trade, right? So it's not just a matter of, let's say, Indonesia growing. It's like where Indonesia now has a trade deal with Turkey and Turkey has a trade deal with Kazakhstan. And like you have this exponential factor which can take place. And across that region, you can have quite a lot of growth and as a consequence, higher consumption of things like oil. People want air conditioning. If you're living in Indonesia, it's bloody hot, right? So things like that, we're watching that transpiring. And and then, of course, there's the actual war element. And the war element increasingly now is, I think, one that's really people are not paying enough attention to it. And we've written about this quite a lot. You're watching across the Western world, almost all Western governments now have begun implementing uh, measures for conscription and talking about preparing to go to war. That's across Europe. The US has even done it. And no one's really paying attention to this because they're like, oh, we can't send our kids to war. No, we won't do that.
Well, they're expanding it out
Um,
to women as well here in the
yeah,
United
well, we
States.
don't know what a woman is, do we? So,
Yeah, that's a good question. Now you're asking the good questions, Chris.
so when I look at it from that perspective, I'm like, you're watching all of the steps being put into place for an international conflict. To ignore that and to not at least buy insurance against it, I think is myopic.
Yeah. So how else can someone prepare outside of their portfolio? For example, all things being equal, if this stuff is it's going to transpire, we may as well profit off of it. But how else do we protect ourselves, in your opinion, outside of the portfolio?
It's a good question. It's one question that we're dealing with. I don't know how much you're familiar with this, but we had an event that we ran in Dubai in March, and at that we trialed a question that I had in my mind, which was basically how do you deal with a great reset? And I had a theory together with a very, very good friend of mine who's now running the project, and it's something called the Mavericks Project. And that's designed to look at these issues and say, how do we actually deal with this to create sort of generational wealth and retain wealth? That's another big component. That's the hard part. I think it's going to be very difficult to do that over the coming decade. And you're going to have to be very nimble and very aware of what's transpiring. Um, I could give you a very short snapshot, I guess, of what I'm doing and what we're doing and why that project has been launched. And for anyone who's interested, it's called Mavericks Project, and you can go to mavericksproject.org. But basically, it's we're looking at how do we address this great reset. We're looking at investing in counter-cyclical, counter-jurisdictional areas, particularly in private equity, so outside of the financial system, not through listed equities, not through anything that has any debt attached to it or anything of that nature. And then there's all components like residencies, citizenships, all that kind of stuff. It all comes into it. There's a lot to cover. So we probably don't have time to cover it all today. But I think looking at those is absolutely critical, in my opinion, if you've got any level of wealth. And you don't have to be a multi-millionaire or decamillionaire or anything to look at these things. Having foreign bank accounts is just a simple one outside of like if you're living in the Western system, you should have banking in the non-Western system. If you're living in the non-Western system, you should have banking in the Western system and vice versa. Like that's just logical, right? And I'm not sitting here saying there's good guys and bad guys. I think all of these people are complete psychopaths. But what you got to understand is that the psychopaths are going to battle one another and they're going to utilize you and I as cannon fodder if they can. And it's our job to make sure that they don't, and so that we can actually escape that on a physical basis as well as with our capital. And that's really what we're trying to address with that particular project. So it's a very nuanced on sort of the answer to that is very nuanced, and it really depends on many factors, personal situations, a whole host of things. But the broad things that I would look at is foreign banking, and ability to go to another jurisdiction should you have to. If your kids are conscripted, if you are conscripted, that shit can come fast. And your ability to go look around and go, oh, I should now get something. Like, no, you'll be way too late. You'll be way too late. They will give you either no time or a few weeks.
Yep.
That's
And you'll be
what
battling it
happens.
out with all the other people trying to do the same thing,
And you
like at a
won't have the
Walmart
ability
during
to.
Black
It's
Friday.
it's just, so um and then so like again, if you've now at least got banking operations in another jurisdiction, preferably with some capital in it, that's the first very, very basic step. You could take it many steps further, as we are with what is this reference Mavericks project, which is like having cash flows in certain jurisdictions that are outside the financial system, having actual assets, having the ability to go there, whether it be via residence programs, citizenship programs, you name it. So that's and I'm not saying we have the answers. I don't. In fact, most of our answers come via our members, who are all dedicated to answering the same questions that we are trying to answer. So yeah, fun
Gotcha.
times.
Yeah, yeah, you've got, the portfolio is obviously important. Your financial, the financial component of your of your entire person, that's obviously a relevant thing. But then, there's also other things that you've got to take into account as well. Um,
Uh, yeah, look, I mean, let's say your portfolio does let's say we were French, right?
right.
And the French are now talking about coming in with a 90% tax. 90%.
Yep.
Like, if you like, I don't know how you can be French and not like immediately be making plans, right?
Yeah.
Now they might not like pull that off. It might not happen. They haven't got a proper government formed or anything, but like the very fact that they're proposing that, and
Exactly.
most people seem okay with it, like the asymmetry behind doing nothing there and getting hosed is just extreme. Like it's mind-boggling to me that people wouldn't at least take some steps to address the potential of that. Because like the steps that you take are almost free. If you're living in Europe, like you can jump on a plane and be in the Middle East in 6 hours and it'll cost you a few $100. Like, why would you not do
Yeah.
that? So yeah. But look, history indicates most people would do nothing. They'll just carry on with their day and they'll be happy to sit down at night and drink a beer and watch the Idiot Box and think
Yeah,
everything's
it reminds
fine.
me of that first day of the Ukraine war, when Russia first made its move. You had this huge traffic jam trying to get out of Kiev. Do you remember that?
Yeah, yeah,
That's going to be everything else at scale,
yeah,
essentially. Like when things
yeah,
really pop off, just think of that traffic jam that you saw in Kiev, because you're not going to be
yeah,
the only one trying to make it to the exits. Everyone else will.
yeah, yeah.
Well,
And
Chris,
then that's the people just physically trying to get out. Like, but then where they're gonna go to? Like, and so that's just like those physical borders being shut. But what happens if they shut down your ability to move capital?
hmm
Right? So now you might even be like, oh, I want to get out and I can cross the border or whatever, but I got no money. Like, what are you going to do? Where are you going to go? You're going to take your family and just land in, I don't know, Istanbul, and now what? Like, live on a park bench and you entered on a 30-day visa? Like, you're screwed. You like, so, you go from being, it's like I like to say, what's the difference between an immigrant and a refugee? I'm like, timing.
Good point. Well, Chris, what I've been doing the last several episodes of this podcast is opening the door for my guest to ask a question to my next guest. So, if there's a question that you'd like to pose to my next guest, what would it be?
Do I get to find out who your next guest is?
Sure, it's Joel Skousen. Do you know who he is?
Yeah, I know he is.
Yeah.
I don't know him well, and I've never spoken to the gentleman, but I know of him. 10 years out, you got one trade you can make. So we just go back to portfolio, forget about all the other stuff. You got you got to put something away for 10 years. What's it going to be?
All right.
I
Good
think I
question.
know his answer, but I'm curious.
Yeah, I've never heard him talk on trading. He's mainly a prepper. Um,
Hmm.
so we'll see what he says.
Yeah.
So my question to you was from Peter Grandich, who was my last guest, and he wants to know.
To be totally candid is, do you believe your faith ties to how you handle finances?
Insofar as psychology,
Faith in terms of
yes.
like religion.
Yes, no, I understand. I think I understand the question.
Mm,
So let me answer it this way. People have asked me, what would you go if you were to go and do it all again? What would you study? They're like, give me a book. Was there a really good book that you read? And everybody's expecting me to come out with some financial book, okay, or an investment book or whatever. And my answer is always the same. And my answer is that I would read psychology first and foremost. I would study psychology and then I would study history. And so, with respect to that question around faith, faith is, I think, it's one of the biggest psychological components that you can think about. People will die for their faith. So if they'll die for their faith, that also means that the way that they'll conduct their lives can be vastly different to how you might think they would if you just looked at it from a practical standpoint. Okay. And that can have and does have huge impacts on financial markets. If you look at most of the wars that have been conducted, or many of the wars that have been conducted over the like hundreds of years, a lot of them have been faith-based, or at least there's been a component of faith that might have been utilized. Could have been good for good reasons or bad reasons, but it is absolutely a huge component of what makes human beings do what they do. In fact, if you go back to 2020, one of the things that I was looking at with a bunch of my friends with the whole um, scam that was going down was, if there is anyone that's going to resist this, or any ideology that could resist this, it could very well be something faith-based, right? Because clearly you can buy people off, right? So you can buy off any politician or group of politicians with um, brown paper bag and enough money, or threaten them or whatever. However, if you come up against someone that literally doesn't give a shit because they are faith-based, you've got a problem, right? Because you don't have any leverage over them. Like, how are you going to move them? If they just answer to God, you can't move them.
yep.
So we actually started looking around the world at societies that were very religious, and we weren't looking for Catholics or Protestants, or we didn't care whether they were Hindu, Muslim, or it doesn't matter, but there were where there was heavily influential faith-based societies and whether they would stand to any degree against the obvious scam that was transpiring. So anyway, I think I'm not going to say whether it should or shouldn't be. I think that's a personal decision for anybody. But I would say that understanding societies and what drives them, including religion, I think is very important, which comes back to just psychology.
Great answer. It actually dovetails to my next question. What are some books that you'd recommend to people to become a better investor? That was
So
actually one of
yeah,
my
well,
questions. So you actually teed it up
yeah.
quite nicely.
Again, um, gosh, I mean, I've read lots of different books over the years. I come back to psychology. I had the fortune of at a young age having an interest in it for a number of other unrelated reasons. And I read a shit ton of psychology, basically university level psychology books. You pick up any of them, just go and read whatever. Actual books are um, that have been influential. Against the Gods by what's his name? It's Bernstein, I think. It's quite a good one. It's a bit of a dry read. I do actually. Um, I've been a proponent of reading George Soros's works,
Hmm.
and largely because, and he's a he's a despicable human being. So don't take this as a as an endorsement of Soros at all. Um, I think to some extent it's like what's it Sun Tzu says, know your enemy. So but he has been very successful because he does understand psychology very well. And there's a lot of nuggets in his books which I think are useful to understand markets. They're useful to understand the kind of individuals that exist in the markets. So I'd say his books are pretty good. Um, yeah, I'm not going to point people to other. There's been another number of other books I like, but I would honestly go out and just start reading psychology books.
Okay. So that was what was the name of the
Oh,
title?
so the Against the Gods is about
Against the Gods.
it's like a historical book on risk.
Okay.
And if anyone reads it, you'll see the sort of tie-ins with respect to psychology and history, and that's what I quite like about it. It's a Bible. It's
Yeah.
a
Have you read
it's a good book.
Psychology of the Crowds by Gustav? I believe it's Gustav. I have it
Yeah.
out here somewhere.
Let me quickly pull it up and see if I can find Against the Gods. What's someone Bernstein or something? I've I read that book. Oh gosh. Um, when I was 20 something. Peter Bernstein. There you
Gotcha.
go. Against the Gods, Peter Bernstein. There you go. It's on audiobook as well. Um, The Remarkable Story of Risk.
I see. All right. Well, we'll have that book a link down below, guys, if you're interested. And Chris, it's been a pleasure coming on. I can't recommend, your newsletter enough. Like I've said, I've been a subscriber for 4 years now. It's been my top newsletter. It's my favorite newsletter across the entire commodity and energy sectors, as well as others. I mean, as we mentioned before, you guys like to look outside the box. So, you're into Argentine stocks, formulae before any of that stuff happened in Argentina. Now you guys are into Ukrainian agricultural stocks as well, stuff that people aren't really thinking about or have on their radar screen. So that's what I really like about you guys in your newsletter. You're always anticipating. I think that was actually a George Soros trait. He mentioned anticipation to events as opposed to reacting to events. So, but anyways, Chris, any concluding thoughts before we wrap up?
Embrace the chaos.
Embrace the
We're in the
chaos.
fourth turning, and you're not going to get out of it. So you got to learn how to deal with it. It's like you're in it. Um, there's a friend who sent through a little meme to me this morning, and it was like like a bar fight, and there's this fucking chaos breaking out. And there's a guy, and then you can see he's just like he's trying to make his way out through the door, and and the analogy was like, you're in the fight. You're not gonna like escape being in the bar. But your challenge is to make sure that you don't get a right hook somewhere along the way, and you just let everybody else like go for it, and try and navigate your way out. And I think it was a pretty good analogy.
Yeah, I think so as well. Where can people find you, Chris?
Where can you find Capitalist Exploits? So capitalistexploit.at, A for Apple, T for tomato, and then our asset management business, Glenorchy. That's GLENORCHY Capital, one word, glenorchycapital.net.
Cool.
And then yeah, that's it. What's my Twitter handle? I think is at capitalistexp.
We'll have it in the description. So
There you go.
yeah,
Make
we'll have
it
all that
easy.
stuff in the
Cool.
description, guys. Be sure to check out the 40% discount on Chris's newsletter, exclusive to Capital Cosm viewers. So be sure to take advantage of that offer. And yeah, hit the like button if you enjoyed this content. Type "Go Chris Go" in the comments if you really enjoyed this content. You agree with Chris. If you disagree, however, feel free to let me know. Comment down below. Really interested in getting your thoughts. And with that said, I will see you in the next episode. Bye, y'all.
Thanks, folks.